Comprehensive S&P 500 Index SPX, long-term, chart analysis, a bearish outlook. Last week's overview, S&P 500 Index SPX performance. Last week, we observed a significant drop in the S&P 500 Index SPX, which decreased by -1.97% following a presidential assassination attempt. This event could have had a more severe impact on market performance. This week's market performance, S&P 500 Index SPX analysis. This week, the S&P 500 Index SPX dropped by an additional -2.06%, making it a cumulative -5.5% decline over the past 3 weeks. The SPX has now fallen below its 50-day moving average line, a threshold not breached since April 2024. This bearish outside reversal week suggests potential further losses ahead. The Conservative S&P 500 strategy. The Conservative S&P 500 strategy is designed to shield investors from bear markets. It tolerates short-term declines without triggering sell signals. Unlike the aggressive bull and bear report, which closely follows short-term indicators, this conservative strategy is grounded in long-term chart analysis and does not react to emotions or news events. The strategy's long-term orientation allows for market fluctuations without attempting to time every minor up and down. Currently, the strategy remains in a bullish position in the Rydex S&P 500 Nova Fund, RYNVX, or other S&P 500 index funds or ETFs like SPY. S&P 500 Index, SPX, and current chart analysis. Last week's market activity. After experiencing a week of losses, the S&P 500 Index, SPX, managed a plus 1.11% rally on Friday, driven by a resurgence in technology stocks. However, this was insufficient to offset the week's overall loss, resulting in a -0.83% decline. This week's market dynamics. In a rapid shift, the Nasdaq 100 Index, NDX, transitioned from a market leader to entering a correction phase, dropping by -11.1% in just 3 weeks. The S&P 500 Index, SPX, has also declined by -5.5%, with most of this loss occurring this week. Positions in both indexes were exited with gains, but the abrupt end to the bull market raises questions. Despite the Federal Reserve leaving rates unchanged this week, the market reaction suggests they may have missed critical signals. Economic indicators and market sentiment. The U.S. labor market added 114,000 workers in July, falling short of the expected 180,000. The unemployment rate rose to 4.3%, the highest since October 2021. This disappointing job growth and increased unemployment rate indicate potential recessionary trends in the economy. Although a yield curve inversion predicted a recession 20 months ago, we have not yet entered one. However, many strategies are now turning bearish. Small caps and market breadth. Small cap stocks reversed their bullish breakout, plunging by -6.79% this week and posting a bearish outside reversal week. The SPX's 3-week decline, coupled with a bearish outside reversal week from its highs and its position below the 50-day moving average, signal a -5.5% loss from its highs. Interestingly, the New York advanced decline line remains near its highs, indicating strong breadth despite major index sell-offs. Historically, steep downtrends or bear markets do not coincide with strong breadth, suggesting an impending change, either a breadth decline or a stock rally. Market-moving economic reports released this week. Job openings, little change to 8.184 million in June, slightly above forecasts of 8 million. S&P CoreLogic Case-Shiller 20 City Home Price Index increased by 6.8% year-on-year in May. Redbook Index increased by 4.5% for the week ending July 27, 2024. Single-family house prices unchanged in May. Compensation costs rose by 0.9% in Q2 2024. Private payrolls added 122,000 workers in July 2024, the least in 6 months. ISM Manufacturing PMI fell to 46.6 in July 2024. Unemployment claims rose by 14,000 to 249,000 for the week ending July 27th. Non-farm payrolls created 114,000 jobs in July, below expectations. Average hourly earnings increased by 0.2% to $35.07 in July 2024. Conclusion: the current strategy for the SPX position is bearish. Aggressive traders are advised to stay in cash, money market funds to avoid potential losses from the anticipated continued downturn. By thoroughly understanding the current market dynamics and economic indicators, investors can make informed decisions to navigate the volatile financial landscape. The long-term, conservative approach remains crucial in these uncertain times, ensuring stability amidst market fluctuations.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.